Hi everyone, I am Suhas Mohan, your tax mentor at BeingACCA, and in the previous video we have discussed the section A of the pre-December 2025 mock, and from this video we will be discussing each question of the section B. In section B you will be given with one case study and each case study will have 5 questions. So that will be a total of 10 marks for each case study. These are also known as objective test questions, and with this we will quickly move on to the first question. The first question is about Zara. Zara started trading on 1st January 2024, selling standard rated clothing and accessories. She registered voluntarily for the value added tax on 1st Jan 2024. The following information is available. All figures are stated exclusive of tax. Guys, this is a very important thing to remember. Usually, if nothing is mentioned, you should always assume the values are exclusive of tax, but otherwise, it will be clearly mentioned that they are inclusive of tax. Okay. Suppose that it is sales. Zara standard rated sales since trading starting to trade were January 2024 to April 2024. It was 7,500 a month. Next is May 2024 to August 2024. It was 9,500 a month. And from September 24 to December 2024, it was 11,500 a month. So guys, remember it is a monthly trading turnover. It's not talking about the entire from January to April, it is 7,500. It is 7,500 per month. And the same with these as well. Let's keep these highlighted. Next, pre-registration costs. Before registering for VAT on 1st January 2024, Zara incurred the following standard rated costs. On 12th October 2023, she bought a new car for £9,500. She still has the car and uses it for 80% for business purposes. This is a very key word. She paid the following amounts for website design services in relation to her business. Here they're talking about services. And here they're talking about a product, that is car or goods. After that, that is 13 March 2023, it was 1,200, and 23rd September 2023, it was £2,000. Okay, these are the values that we'll be remembering. Next, bespoke necklace. Zara occasionally sells some unique high value items. On 1st February 2025, she received an order for bespoke necklace. The customer paid a deposit of £2,000 on 10th February 2025. Okay, this is something that we'll have to remember. The necklace was dispatched on March 1st, 2025. The dispatch date of the product was on March 1st, 2025. The invoice for the balance was 3,000. The invoice for the balance of 3,000 was issued on 12th March 2025. The customer paid the balance on 21st March 2025. Okay. The invoice for the balance was 3,000 on 12th March 2025. We'll highlight this. And also the customer paid the balance on 21st March 2025. These are the points that we'll have to remember when we're looking at the case studies. So if you highlight pointers like these, it will be easy for you to refer back because the questions will mostly be revolving around these points only that we'll be discussing, because these are the key values and the key dates that we should be that will be used in your questions. Next is your flat rate scheme. Zara is considering joining the flat rate scheme from 1st April 2025. From that date, her expected standard rated turnover will be 11,500 a month. Okay. And her standard rated purchases will be 5,200 a month. Always remember, when a person or when an individual is entering into a flat rate scheme, they will not be able to reclaim input VAT. So because of this, the standard rated purchases will not be applicable, and it is just given as a diversion from your actual value answer valuation. Always, whenever they're talking about flat rate scheme, your input VAT will not be recoverable. All right. With this, we'll move on. We have completed reading our question and we will move on to our first question. From what date Zara would have been compulsorily required to be registered for VAT and to start charging output VAT on her sales? They're asking about compulsorily registered for VAT purpose. And here for this question, the topic that would be the values that question would be tested from is this one. So here, as we can see, we'll open our scratchpad to identify the calculations. We can see the standard rated sales. So when is it important for for Zara to be compulsorily registered with VAT? When it is historic. There are two types of tests. One is historic turnover test and one is future prospects test. Historic turnover test means that in the coming months you should have a total turnover of, in the previous months you should have a total turnover of 90,000 pounds. If it exceeds 90,000 pounds, that is when Zara should be compulsorily registered for VAT. So it should notify VAT within 30 days after it crosses the 90,000 threshold, and the day after the notifying HMRC with after the 30-day period is when it should be compulsorily registered for VAT. So here we are taking about the historic sales from January all the way until December are the sales values that are given to us. So from January 24 to April 24, which comprises of 4 months. So Jan to April would be turnover. Turnover would be, it would be 7,500 into 4. That would give us 30,000. So by April, it is not expected to exceed 30. It is not expected to exceed 90,000. So April is fine. Next, let's consider May to August. May to August is also another 4 month period. So we'll see how much is the turnover, coming up to in August. So that would be 9,500 into 4, giving it a total of 38,000. So even by August, the total turnover that's coming up is only 68,000, which means even by August, it is not exceeding the 90,000 threshold. Now let's take September. September, because it's coming closer to the 90,000 threshold and per month it is only 11,500, what we can do is identify how many months. So in September, it is coming up to 11,500. So total would be 68,000 plus 11,500, which means it is still short of the 90,000 threshold, but it is closer to the threshold. So we'll take one more month coming up to October 2024, which would be equal to another 11,500. So to this, if we add 11,500, it will come up to a total of 91,000, which means in October 2024 is when Zara would be exceeding the threshold of 90,000. Because it will be exceeding the threshold, it means by 30th October, Zara is expected to exceed the threshold. So it should notify HMRC, it should notify HMRC within 30 days. Within 30 days. That means it is 30th October 2024. So it should notify HMRC by 30th November 2024. But what is the question asking us? From what date would Zara have been compulsorily required to be registered for VAT? So here it's only talking about notifying HMRC. Okay, let me write notify here. HMRC within 30 days. But after that, the day it should be effectively registered for VAT would be the day in the next falling month, the month following this 30-day threshold, the one day after that, which is 1st of December 2024. 1st December 2024. It is always remember the day it should notify HMRC within 30 days, and one day after the days or after the 30-day threshold is when it should be compulsorily registered for VAT. So it will be 1st December 2024. And though your value might be correct until 30th November, but here they are asking us about when should compulsorily required to be registered for VAT and not notification to HMRC. So it should always be 1st December 2024 and not 30th November 2024. Hope you guys understood this question. And with this, we'll move on to our next question. What is the total amount of pre-registration input VAT that Zara was able to recover on her first VAT return when she registered voluntarily on 1st January 2024? So here, if you see it, this section is actually giving you valuable points that are relating to the pre-registration. Here, as we can see, on 12th October 2023, she bought a car for 9,500. She still has the car and uses it 80% for business purposes. But for pre-registration VAT to be reclaimable, the asset, the goods that are bought or services rendered should be solely utilized for business purposes, which means she will not be able to reclaim any input VAT on the car that has been purchased earlier to the registration, though it falls within the 4-year threshold. So for goods that have been purchased before goods that have been purchased for business purposes before the registration to VAT, the eligibility period is 4 years, and the condition is that goods purchase should still be in the inventory. But for services, it should only be incurred 6 months before it has been registered for VAT purposes. So here we have two things, two services being rendered. One is being rendered on 13 March 2023, and the other is being rendered on 23rd March 23rd September 2023. While Zara has registered on 1st January 2024. So 6 months back would only mean until July 2023. But this service of 13 March, the website design service, which was rendered on 13 March 2023, will not be applicable because it does not fall within the 6 months threshold. So for that reason, this is not applicable. So this is again strike through. Coming to the next one, 23rd September 2023, she paid the following amount. It is £2,000. So because it falls within the 6 month threshold and it is for the purpose of the business, as you can see, it is website design services in relation to her business. This 2000 is, you can reclaim input VAT on the £2,000 that has been incurred. Now, what is the question that they are asking for? Total amount of pre-registration input VAT that Zara was able to recover. So on 2000 is what she can reclaim her input VAT on. So that means VAT is always at 20%, as you all know that. I think there's some issue with the this coming up. So let's calculate it manually. It would be 2000 into 20%, which would be equal to £400. All right. So giving us this second is this answer is the third option is the right answer. All right. With this, we'll move on to our next question. Always remember, guys, it is very important that you stick to your timelines. Like for every question is of two marks. So the maximum time that you should spend for one question should not exceed 3.6 minutes. If it exceeds that, you should either try to compensate it in the other easier questions, mostly theory ones, because they will be straightforward. All right. Yes. Now they're asking us to identify the VAT tax points for the deposits and the balancing payment received for the bespoke necklace. So what is a tax point? A tax point is when it becomes chargeable for VAT purposes. So here we have two pointers that we should know. One is a tax point for deposit and the other is for the balance of £3,000. So when was the deposit made? The deposit was made on 10th February 2025. But what is the first condition that you should look at? It should always be the basic tax point. The basic tax point is always the date of the goods being dispatched. As we can see, the necklace was dispatched on 1st March 2025. So we have identified the basic tax point at this point is 1st March 2025 because the goods were dispatched on that date. But when will we consider an actual tax point? When the customer has paid before the goods have been dispatched, then that will become the actual tax point. So in this case, we can see though the necklace has been dispatched on 1st March 2025, the customer paid before the goods being dispatched on 10th February 2025. So for that reason, 10th February 2025 will be considered as a tax point for this deposit amount and not the basic tax point or the date of dispatch. So let's select this option. Next, for the tax point for the balance of £3,000. So again, The basic tax point will be the same, 1st March 2025. So for this purpose, I will remove the strike off for reference understanding. So here also same. It's the same thing. If any payment has been made before, it will be considered, but the after date would be considered when an invoice has been issued within the 14 days threshold after the goods being dispatched. That will be considered as an actual tax point. In this case, was the 3000 payment made before 1st March 2025? No, it was not. But the invoice for the balance of 3000 was issued on 12th March 2025. So yes, if you can see here on 1st March, though the necklace was dispatched, the invoice was issued within 14 days after the goods were dispatched. So within 14 days after the basic tax point, so it will be considered as your actual tax point. So 3000 was issued on 12th March 2025. And as we have already discussed earlier, the customer paid the balance on 21st March 2025. So this is nowhere relevant to the question because the payment was not being made before the goods being dispatched. So this is not relevant. So the date for this question would be 12th March 2025. So as you can see, basic tax point and all of these are very much theoretical in nature. You should be able to remember what a tax point is and what are the conditions for when should a basic tax point be utilized and when should an actual tax point be utilized. So if you are not clear with these concepts, it will become difficult for you to answer these questions. So I would urge you all not only solving questions, but spending time in understanding theory is equally important. All right. With this, we will move on to our next question. Next question is, what is Zara's monthly VAT payable if she joins the flat rate scheme from 1st April 2025? You should assume a flat rate percentage of 7.5%. Always remember, in the examination, the flat rate percentage will always be mentioned to you. You do not have to worry about that. The flat rate will always be mentioned to you. Okay. So here they're asking us about how much VAT would be payable on it. So here we know it is 11,500 a month. But what are they asking for if it is flat rate scheme? Always remember when you're calculating it for flat rate scheme, it should always be at a VAT inclusive price and not VAT exclusive price. All right. So for that reason, we will open our scratch pad and we will see it is 11,500 into 120%, and on this 120% is what we will be charging the flat rate on. And as I've already discussed with you, it is always the standard rate purchases input VAT cannot be reclaimable on your flat rate when you're considering flat rate percentage. All right. Hope this is clear to you guys. Are you guys having any doubts so far? So this 11,500 into 120% into 7.5% will be giving us a total of 1035. All right, because they're asking us for the monthly VAT payable. It is not the annual amount that is to be payable, but they're asking about monthly VAT payable. So for 1 month, we know it is 11,500. And it has been mentioned that all these are exclusive of VAT. And for flat rate, we should take it at VAT inclusive percentages. So we're multiplying this with 11,500 into 120% to get a VAT inclusive value. And to that, if we multiply 7.5%, we will be getting a value of 1035. All right. With this, we can move on to our next question. As you can see, the next question is, which two of the following statements are true if Zara joins the flat rate scheme? The first thing is Zara must still charge output VAT at 20% on standard rated supplies. This is absolutely a true statement. The flat rate scheme is only for the purposes of the VAT being payable to HMRC. It is not to be changed on the invoices. Any invoices that you issue, VAT inclusive invoices, should always be charged at 20% and not at 7.5%. So this is a right option. Now let's take a look at the other options in order to identify the other things. what is the second right statement? Zara no longer needs to issue VAT invoices to customers. This is false. Zara is still liable to issue VAT invoices to the customers. Only then she'll be able to reclaim the VAT. All right. So this is not right. Next, so we'll strike this off. Next option. If Zara's total VAT inclusive turnover for the previous year exceeds 230,000, she must leave the scheme, which is again a straight up theory option, and that is right. Zara can enter, or any individual can enter into a flat rate scheme if their income in the future 12 months does not exceed 150,000, but they should exit the scheme if in the prior year their VAT inclusive turnover has exceeded 230,000. Okay, to join the scheme, to join the scheme, it is the coming 12 months, the turnover should not exceed 150,000, but they should immediately exit the scheme if the VAT inclusive turnover in the prior period, in the prior year, or in the prior year exceeds 230,000. All right. This is a very important point to remember. So with this, we have identified our second right option as well. But then now let's take a look at the fourth option. If Zara joins the flat rate scheme, she cannot also use the annual accounting scheme, which is not true. Even though they enter the flat rate scheme, they are always eligible to, account with the annual accounting scheme. All right. So with this, we have identified the two options. Guys, again, with this question also, I'm emphasizing on the importance of theory. You guys can solve as many questions as possible, like the solving questions as possible, which is very good. But along with that, it is equally important that you focus on the theory part of it. All right. Next, let's move on to the next part of it. I think with this, we will come to an end of the section in the first question of section B, and in the next video is where we'll be discussing the second question of section B. All right. Bye, guys. All the very best for your preparation.